Typically, most big businesses are not really a good reflection of the real state of the economy and what's going on. But in this particular case, I think it is, because when we look at some of the nation's largest banks, they can reveal actually some very interesting insights into consumer activity. They have millions of customers, regardless of how much the big banks continue to rip people off with terrible savings rates and, less than ideal mortgage interest rates and all these sorts of things. For some reason, people still flock to these big banks and still open up accounts with them. So they have a lot of leverage and a lot of pull, but also a lot of information that we can look at. JP Morgan, as well as Wells Fargo, just posted drops in profits from a year ago as part of their third quarter earnings results this past week. The funny thing about that is investors are actually happy about this and cheered this because the declines were actually not as bad as expected. But one thing that their data reveals is that there's virtually no loan demand right now of any kind, guys. They say that people are not springing for new loans as interest rates remain elevated. It's a sign that consumers are hesitant to take on new debt or are at least waiting for the Federal Reserve to follow through on signals that it will continue lowering interest rates. I've seen people say in the comments that, people are just not taking on new debt because they're being responsible, or, people are not going out to restaurants because they're finally being responsible. This doesn't mean that we're in a recession. This just means that, people are finally starting to wake up and get smart with their money. Well, there might be a small percentage of people who are doing that, especially if they watch channels like mine, because I've heard from you guys personally and people who are doing that had poor spending habits before. And if that's you, I do congratulate you. That is excellent to hear. But to sit there and say that the reason why the restaurant sales are down and people are taking on less debt is because consumers are being more financially responsible is a joke. The reality is people don't have the money, guys. If you saw my video yesterday, literally 76% of Americans right now are saying they're having a hard time paying the bills. So people typically don't really go out to eat much if they're having a hard time paying the bills, okay? Also, people aren't taking out new loans according to these big banks because they're probably already eyeballs deep into debt. We know this for a fact with the record high amounts of household debt right now. People have more debt per household than ever before in history, and it just continues to climb. But despite all that, the big banks are saying that loan demand is weak, but the consumers are in solid shape and they don't see any concerning credit quality trends. So another thing we can look at is these are the same type of stories and headlines that we saw right before the big financial crisis back in 2008. People were still talking about these real feel-good stories about the economy right up until everything completely collapsed, guys. Like literally, it went from day to night in terms of sentiment, in terms of how these businesses were talking about how well everything is going. It didn't take very long for it to change. Chief Financial Officer at Wells Fargo says that year-over-year growth rates and spend with credit or debit is down a little bit from earlier in the year, but it's still quite solid. So they're just saying because it's not a massive pullback in people spending, then somehow that means everyone's okay. But I interpret the data differently. I look at it as if people are cutting back on spending when things cost more than ever, how many things are people actually giving up and not buying anymore because of how much the cost of living has gone up? That's the way I see it. Because you can't look at spending dollar for dollar and compare that to what it was a year ago or even a couple years ago, because inflation has continued to go up since then, which means everything we buy costs more than it did a year ago or 2 years ago, etc. JP Morgan's chief financial officer said that even though credit card net charge-off rates rose from a year ago, across the board, our consumer narrative that the consumer is fine remains in effect. So everybody is holding up this big front. The Fed, the big banks, and the government all are working as one big team right now to present this front that everything's okay until it's not. And that's exactly what they did right before we had the huge recession in 2008. All you got to do is just go back and look at all the articles, guys. You can see anything before January 2008, for the most part, is all sunshine and rainbows just like this. But they do say that they're going to keep monitoring their loan growth, especially because they say if we don't see a meaningful uptick in people taking out more loans as interest rates continue to come down, then it might be something that we need to be more concerned about. Well, you guys can already get a preview of that happening right now in real time with the housing market, because the rates are more than a full percentage point lower than they were a year ago, and there's still fewer buyers than there were a year ago. In this coming week, Bank of America and Citibank are going to report their third quarter earnings results as well. So maybe we'll have some more insight into this as they make their report. And then after the blowout jobs report that we had in September, Goldman Sachs came out and actually lowered their outlook of a potential recession from 20% to 15%. However, another investment firm called Martin Curie, they actually increased their recession odds after this last jobs report. I wonder why that is. They went from 35% to now a 40% chance of a recession, guys, which all of this is bogus anyways, because we are in a recession right now. At least specific sectors of the economy are, and the average person is feeling a recession regardless of whether or not the government wants to admit it. Doesn't really matter. All that really matters is what the average person is actually experiencing, in my opinion. So the reason why this investment firm, Martin Curie, is saying they believe recession odds are increasing is because of inflation is the biggest problem, okay? In fact, we just got the most recent inflation numbers. They went up, not down, even after the Fed has been repeatedly saying that everything is okay on that front. We're just worried about the labor market now. And obviously inflation is a global issue. It's not just something we're experiencing here in the US. And the official numbers in places like Europe right now, you know, it's like 4 to 5%. In the UK, it's at 6%, which is probably like the real number that we have here in the US right now. But here's another thing we have to look at, the manufacturing index. This is another reason that Martin Curie says that recession odds continue to increase. Manufacturing in the US has been on a steady decline. The sector contracted in September for the 6th month in a row, and the ISM manufacturing index was at 47.2 in September, guys. Any value below 50 indicates a pullback in manufacturing activity. I remember when I covered this in a video earlier in the year, probably back in like April or so, the manufacturing index was sitting right around 50. And now we're at 47.2. So things have continued to deteriorate over the past 5 or 6 months or so. And typically this is also another indicator that we could be facing a recession. In my opinion, it's just another thing that proves that we're already in one. And another reason that people are having a hard time spending more money these days, guys, is because the cost of insurance has gone up so much for everybody. And I want to talk here about insurance because there's a few things that I saw and were brought to my attention from you guys as well. The first thing is there was a couple here in California that actually had their homeowners insurance canceled because of a picture that was taken from space. So this couple has been customers of Liberty Mutual Insurance for about the last 20 years, and because of an image that was taken from space of the condition of their roof, they actually had their policy canceled. The picture from space showed that they have moss growing on the roof and mildew, algae, mold growth, all which can negatively impact the integrity of the roof. So instead of just giving them a chance to say, hey, we're going to cancel your policy if you don't fix your roof. Nope, we'll just cancel you instead. I mean, at the very least, for customers that have been with them for this long, they could have given them a little bit more of a heads up as a courtesy. And this shows you another thing too, guys. Like, this is not just a Florida problem, because now if you want to get insurance in Florida on pretty much any house, you are going to have to get a new roof if that roof is more than like 10 to 15 years old. That's a guarantee. But now you're starting to see this become more of a problem in other places too, like here in California. And I wonder how much longer it's going to be before this just becomes the standard, where if you buy a house and the roof is, more than 10 to 15 years old, you got to replace it, even if it looks like it's in good condition. But according to an insurance broker who's been writing insurance policies for the past 30 years, he said that insurance companies actually have to give customers an opportunity to fix a problem, as well as the option to prove that the insurance company got it wrong. So clearly, in this case, Liberty Mutual didn't do this for this couple, and they could probably sue them. So this couple claimed that they hired a roofer to prove that the roof was in good condition still to the insurance company. Of course, they rejected that and didn't want to have anything to do with that report, and they still dropped them anyways. But how much does a new roof cost, guys? Depending on the house, depending on the materials and the size of the roof, you could be looking at anywhere between $15,000 and $30,000, maybe even more. You know, so you wonder why people have pulled back on spending money. People get hit with these major unexpected expenses like that, but their premiums for all these insurance policies have risen as well. So you're really getting hit with a double whammy in these sort of situations, and people don't have extra money to pay for stuff like that. And what about Citizens Insurance in Florida? You know, Florida just got rocked by Helene and Milton, and you can be sure that there are thousands of claims pouring in by the hour right now in Florida. But obviously, Citizens has been unloading a lot of their insurance policies to other companies because Citizens is now able to purge people if another company is offering a rate within 20% of what Citizens is offering. They've already dumped hundreds of thousands of people this year and will continue to do so throughout the end of the year. So at the moment, the only way you can even get a Citizens insurance policy is if a private insurer costs more than 20% of the Citizens quote, and also your property has to be valued at $700,000 or less. Unless you're in Miami-Dade County, then it has to be $1 million or less. But what a lot of people don't understand about Citizens Insurance is it actually cannot go insolvent like a traditional insurance company. You know, I've seen a lot of people say in the comments that, oh, Citizens Insurance is just one major hurricane away from being completely broke and insolvent. But that's actually not true, because the way that it's structured is that they will actually never go broke and be insolvent. Citizens is actually allowed by state regulations to implement a premium surcharge to its policyholders and other Florida consumers to ensure all claims get paid. And the other customers include people who have other kinds of policies like auto insurance, boat insurance, pet insurance, even renter's insurance. And if you live in Florida, you will see those premiums go up if Citizens for some reason cannot cover all of the necessary claims. And as of right now, Citizens Insurance says they have about $15 billion it can tap into, and it's going to be more than enough for both hurricane claims that they expect to be coming in. And the reason for that is because none of these policies cover flood insurance, guys. I talked about this a little bit before, but most of these claims are going to get denied because if you had flood damage, whether it was from rain, whether it was from actual storm surge or whatever, your claim is not going to be processed and you will get denied. You're not going to be covered by this because you need to have flood insurance for that stuff. Even though Citizens is likely to have the money, at least they say they will right now at this point in time, a lot of the private insurance companies may once again be bailing from the state of Florida because they're on the hook for so many of these claims as well, assuming it wasn't involving flood damage. And of course, I feel no sympathy for these insurance companies whatsoever because these guys have been really raking in the dough. In fact, big insurance companies are having a great year in 2024, and somehow we're supposed to feel sorry that, we're losing money and we're not making a profit, so therefore we need to raise your rates. Like, what? Take a look at this. All insurance companies have raised their premiums over the last couple of years. That's a fact. No matter where you live, you've probably seen your rates go up. When you have companies like Progressive and Travelers Insurance posting double-digit gains so far this year. So has Allstate. Even Universal, which is Florida's largest private insurance company, saw their stock prices go up about 22% this year, guys. Take a look at this chart. You can see going all the way back to 2018 through 2024, you can see the gains in the share prices of these companies. And we're supposed to feel bad. Oh, we're losing money. We can't continue to write policies where you live because it's too dangerous. We can't make a profit here. Well, clearly they're doing just fine and having one of their best years ever, except for maybe the exception of 2023 when you look at this graph. And the real issue is that everyone is affected by this. It's not just people that live in Florida, because these insurance companies spread the risk to other areas because they have more payouts and more claims in one area. So since they are, international or at least national companies that work with most of the country, so you have insurance companies like Allstate and State Farm, they take these major losses, right, after these big storms. storms, but then they have to find ways to make up for it and to keep these profits rolling in like this. So what you see is people in Kentucky and Idaho and other places where there's just not really that many natural disasters see their insurance go up as well. And I know it's not fair, guys, for people that live in safer areas to have to subsidize insurance for other people that live in more risky areas like California or Florida. But that's just the way these companies work. If you don't like it, take it up with them. They're the ones who are doing this in order to keep their pockets full, okay? It's not like people in Florida are saying, oh, please help us. We need people in Idaho and Kentucky to pay more because we can't afford it. It's not like that. This is something that the insurance companies decide all on their own. And one of the main reasons that homeowners could see their premiums continue to go up is because of the reinsurance market. Reinsurance is essentially insurance for insurance companies. When insurance companies run out of money to pay for claims, then they can tap into reinsurance, which is basically like a backup fund, and they have insurance in case they run out of money. And those rates have been going up as well. So reinsurance rates are determined by worldwide losses with all these different natural disasters. Doesn't mean just here in the US, as we're talking everywhere. So basically how this system works is one place sees a disaster, lots of claims get paid out, and everyone ends up paying, guys. So really, you know, insurance is a global game when you really look at it. So the more natural disasters we continue to see globally, and the amount of property damage those cause, the amount of claims they have to pay out, then the more insurance is going to go up everywhere across the world. And of course, the frequency and severity of these events has been increasing. Therefore, insurance prices are going to go nowhere but up, guys. And you can also guarantee that these companies are not going to let their bottom line slip. They're just going to continue charging customers more. And especially when we're talking about homeowners insurance, you don't have a choice. If you have a mortgage, you're required to have it. Whether they end up paying you with a claim is a whole other story, but doesn't matter, you have to have it. And with so many claims coming in worldwide, it could actually shrink the reinsurance market, which will make reinsurance more expensive for insurance companies, which is yet another cost to pass along to you. So if you're wondering why everybody's broke, or if you're wondering why people aren't taking out loans or not going to restaurants, it's not because they're being financially responsible. It's because they're getting hit with the cost of a new roof, hit with the cost of higher property taxes and higher insurance that is keeping people down. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.